proposal so we understand where we're starting from. The first thing to understand is that the House Republican budget and the Senate Democratic budget will never, ever end up being law. That's not the point. The point of the budget proposal is to draw a line in the sand and say our negotiating process is starting right here, and then we'll go from there. But it's important to understand where those parameters are. So let's start with the Republican budget. Paul Ryan, based on the fiscal conservatives, is forced to come out with a budget that balances in 10 years with zero new tax revenue. So how does he do this? Well, the first thing he proposes is that we repeal health care reform, also known as Obamacare. Now, you remember that 3.8% tax I talked about earlier? That was a health care reform tax, and it's going to generate $700 billion of new revenue to the federal government over the next 10 years. He keeps that revenue. In addition to that, for health care reform, there's $700 billion in cuts in Medicare reimbursement rates to doctors and hospitals. He keeps those cuts too. So we're keeping all the revenue and the cuts from healthcare reform and getting rid of changes to the healthcare system. That's what Paul Ryan has to do in order to help balance the budget in 10 years. He also turns Medicare into a voucher system, and this has been vastly mischaracterized in the press. Bottom line is simply a choice. Starting in 2024, if you're retired, you'll have a choice between traditional Medicare as you understand it today and a private option where you literally would go out and buy a private insurance option, and the federal government would help offset some of those premium costs because you're not taking out the Medicare system. That's all that voucher system is. What also is included in Paul Ryan's budget is turning the Medicaid system into a block grant program. The only value to the federal government is that it turns that variable cost, in other words, we don't really know at the federal level how much we're going to spend on Medicaid every single year. We turn that into a block grant, in other words, a flat amount that goes to the state, and then it's up to the particular state, in this case New Jersey, if their claims experience in Medicaid are higher than expected, okay, Chris Christie, figure out how you're going to pay for it. So it takes the federal government out of that shared responsibility of the Medicaid program. But unfortunately, that's still not enough. In order to balance the budget in 10 years, Paul Ryan still has to have an additional $4.6 trillion of spending cuts in this 10-year period. Now let me put that number in perspective for you. The sequestration spending cuts, and everybody said how meaningful and significant and damaging these cuts were going to be, and the president was way too far out in front of that issue because by definition the way we're going to feel those cuts is by slow implementation. But when they hit, they're there, and they're real cuts. That was only $1.2 trillion. Over the same 10-year period to balance the budget, Paul Ryan has to add almost 4 times that much on top of the $1.2 trillion in cuts. So you can imagine this is a fundamental redefinition of the federal government. Not saying it's right or wrong, I'm just saying that's what it is. But that's also not to say that the Democrats' budget is all perfect and without issue. It certainly isn't. Patty Murray in the Senate put together the budget that passed the Senate. And the first commitment she made is it would be a balanced approach. Well, we already talked about what balanced means. What that means is $975 billion of additional tax revenue. Now, just like I put Paul Ryan's number in perspective, let me put this number in perspective for you as well. We talked about the fiscal cliff agreement. We talked about how it really was a tax agreement. We talked about how it was the largest tax increase in U.S. history in dollar terms. Well, over this 10-year period, that's going to raise $620 billion over this 10-year period. The same 10-year period that Patty Murray needs to add $975 billion of tax revenue increases. When you combine those two numbers, you get somewhere around $1.5 trillion, $1.6 trillion. All of that is being focused on 2% of our population. And it's not the bottom 2%, is it? It's our clients. So it's a meaningful, significant change in progressivity of the U.S. tax code. Now, as Patty Murray said, it is a balanced approach. There's $975 billion of cuts. Some will argue that they aren't real cuts. For example, some of the monies there are counted from not spending money in Afghanistan because we're not going to be there. And we can argue that that's not really a spending cut, but whatever. What's most important to understand about Patty Murray's budget proposal is that there are no entitlement changes. And I showed you that pie chart, didn't I? Is it reasonable to you to think that we can at least manage our fiscal health in the United States without entitlement changes? I don't think so. I just don't see how those numbers work. Now, Patty Murray would also add about $100 billion of additional government stimulus over this 10-year period, primarily focused on infrastructure development and job training. She would also cut significant money out of the defense background. So those are the two lines in the sand of the two parties. And I think the reason President Obama drug his feet in releasing his budget proposal is he wanted to be perceived as making that first foray into compromise. So let's talk about the president's budget proposal. The first thing he would do is eliminate the sequestration cuts completely. And he would substitute those cuts for changes in the entitlement programs. Now, the first change that he would make is actually start means testing Social Security benefits for those of us who are under age 55. So the higher our income, the higher our net worth, we would actually receive some formula less than our full benefit that we qualified for. Now, again, that's under age 55. It's important to understand that. The one that we hear the most about, of course, is changing the cost of living increase calculation within Social Security, going from a traditional CPI to what's called a chained CPI. And chained CPI simply takes into account consumer buying behavior. And the best example I've heard of that, if the price of beef is going through the roof, guess what we're going to have for dinner? We're going to have more chicken, right? Because we don't want to pay that high price of the beef. So that's somewhat logical. That makes sense. That's what we do as consumers if we need to tighten our budgets. Well, so that maybe is a reasonable plan. But this is a learned audience. Let me ask you a question. Is that the only place chain CPI would impact in the tax writing of the United States? No. Our marginal tax brackets, they grow by CPI every year too, don't they? So if we change and go to a chain CPI on our marginal tax brackets, they would grow more slowly, just like Social Security payments. Therefore, as we earn more money, we would move through those brackets more quickly, thus paying more in taxes. It's called a stealth tax effect, because nobody changed the bracket, but yet we're paying more in taxes. So it's important to understand that it's not quite as simple as making changes just to the Social Security system. And then finally, on the Medicare front, it's all about cost sharing. And that's going to be on a means-tested basis for those of us under 55. So to the extent that we have a higher income or a higher net worth in retirement, we need to anticipate and start helping our clients understand that they have to be prepared for shouldering a higher percentage of their medical costs in retirement. Now, that was interesting, and I don't think that was anything new. As a matter of fact, this is the same proposal that President Obama had laid out for Speaker John Boehner back in December. But what's different is, it's important to understand, this is the first time that President Obama has ever put this in writing. And that's a direct impact of the president's dinner that he had with the Republican senators back last month. Those Republican senators asked the president to get out in front and be a champion for change in the entitlement programs, to give the Republicans cover to say, okay, maybe we can meet this president halfway. And that was the entire intent of that dinner, and President Obama is starting to fulfill those promises. Now, inside that budget proposal, there were also some surprises, weren't there? Probably the one that surprised us the most was this change to qualified plans with a limit, if you will, of $3.4 million. And it's somewhat confusing. It's like, well, where did that come from? We haven't heard that. Well, actually, it's pretty logical where it comes from. Where it comes from is the defined benefit marketplace. As you know, as a 62-year-old person, your maximum defined benefit that you're eligible to fund is $205,000 for joint 100% lifetime income. All right? So $205,000. So what the government did is they said, well, if that's the way the pension industry works, why are we applying that same methodology to 401ks and IRAs and Roths? And what they did is simply ask the annuity industry, if I want to generate a $205,000 income for a 62-year-old couple, 100% survivorship for the rest of their life, how much can I fund? And they came back with $3.4 million. So that's where that number came from. But that also implies that the number is variable based on current interest rates, based on market performance, and you're absolutely right. This is proposing an absolute nightmare of administration in trying to manage this process. Now, one thing that's important to understand, there is some confusion out here by clients. If they have an account balance that's north of $3.4 million, they do not have to take a withdrawal out of that plan. All it says is that if by market performance that balance exceeds $3.4 $3.4 million, you can't contribute this year. But then next year, market performance unfortunately drives that below $3.4 million. Okay, you may be eligible to participate and actually contribute again in that year. But again, you can understand the complexity of the administrative challenge to try to manage that for all 330 million of us across the country. Now, in addition to that, President Obama, in a balanced approach, demands some tax changes. The first tax change he would make is capping itemized deductions at 28%. So any of your clients' earnings are in that 33, 35, or 39.6% marginal rates, they would start being impacted by that 28% cap. President Obama initially applied that to any tax deduction. So we're talking about the share of our health insurance premium that our employers pay, the tax we pay to the state of New Jersey, the municipal bond interest. What about charitable donations and mortgage interest rate deductions? All of those things were just wholly capped at 28%. Now, this is where the Congress has a little bit of a challenge. The problem is every constituency behind each of those individual deductions is going to show up in force and try to explain to Congress why they deserve an exception. And so that's why I believe Congress, in their infinite weakness, will pick the most politically expedient method if we deal with this issue. And I think a cap like this, or like one that Governor Romney proposed, is likely the direction as it relates to these issues. Now, I do not believe municipal bonds will lose their tax-free status. I just do not see that happening. That's in neither party's best interest. Neither party wants that eventually to happen. But this is a starting point at where President Obama started. The second thing he suggested is that we apply the Buffett rule. And we finally have a little more details on that. The Buffett rule would apply a minimum 30% tax for anyone starting at $1 million and above. It would taper in where they're fully paying that 30% minimum tax starting at $2 million of adjusted gross income. What's interesting about that, as you obviously know, is that would eliminate the decreased or lower tax rates based on dividends and capital gains for these clients. That would just be gone because of that minimum tax. In addition to that, President Obama would have us go back to 2009 on the estate tax law. Remember what I said about permanent tax changes? Here's an example of where we're already talking about changing that moving forward. That would take us back to a $3.5 million estate tax exemption. Most important to note, that would also be a $1 million lifetime gifting limit. So no longer have we married the estate tax, generation skipping, and gift tax limits. They would now go back to the way they used to be in the old days. And 45% maximum. Now the question is around spousal portability. The way the law was written, and I read it 4 or 5 times, this estate portion of the law, we would go back to 2009 law. Well, spousal portability did not exist in 2009. So the way I read the law, or the proposal that President Obama puts out, is that spousal portability would also go away. Now, I think that would be a likely change that we'd see, that they would reintroduce that into the law. But in addition to that, finally, these loophole closures that we've heard so much about. Carried interest. Our clients who are LLC owners or S-Corp owners, and our ability to manipulate our W-2 income, right? Because I, as an S-Corp owner and employee, can pay myself a $20,000 W-2 income, and at the end of the year, take a $300,000 partnership distribution, right? Well, why would I do that? Because I have to pay taxes, income taxes on all 320. The reason I would do that is I only pay payroll taxes on that $20,000 of W-2 income. So that ability for me to manipulate my W-2 income, which, by the way, I don't do in case there's anyone here from the IRS, that ability to manipulate the income would no longer exist. So with that, all of these things have to